Hello, Joseph Jones is here.
Hi, Joseph. Hey. How are you?
Hey, we can hear you. Perfect.
All right, great. Sorry about all that. I'm not sure what happened. I downloaded the software and such, but
no problem. We can both hear you and see your screen, so everything is perfect. Enjoy the interview.
Okay,
right,
Joseph. So nice to meet you. Welcome to our community to FACE. And I was wondering if you could tell us a little bit about your journey into the crazy science of economics and financial markets.
Yes. Yeah, and thank you for having me on. I started my journey about 12 years ago or so. I was interested in economics in general, like how macroeconomic policy impacts markets and prices, like either from an end user perspective and such. And I went to grad school and graduated in 2011. And then I started realizing how the distortions, like how the monetary policy, I guess you'd say, impacts the markets, and sometimes in positive ways and other times negative ways. So I started studying to that, and then I became interested in looking at doing financial analysis and such, and started working as a data scientist and doing modeling, like different kind of economic modeling. When I was in Russia, I basically in 2015 I helped set up risk
the hacking operation for the 2016 presidential race.
No,
I'm kidding.
It wasn't in any of that.
Okay.
But no, it was so I basically helped look for signals, like say if there's going to be a major ruble decline, like you're looking for signals in the market. And oddly enough, a lot of it just comes down to sentiment. How many times politicians have, I guess you would call, negative views towards the country, that would increase the rate of, say another round of sanctions and things of that nature. So
okay.
Yes. And then, so now I'm starting site doing helping individuals circumvent the upcoming technological, I guess you call it, revolution, and a number of levels, looking at from a business owners and from a end users perspective, and as well as, of course, a trader's perspective. So those are the main things. Yeah. Okay.
So I mean, we've already gone, the market, I've talked to some people that were interviewed in the old days, pre-high frequency trading, algos, just tape readers that were interviewed by Jack Schwager and Market Wizards. And, they don't like the kind of markets we have right now being run by machines. So the markets are already there, aren't they, Joseph, as far as being run by machines?
Yes, yeah. And the scary thing is now, I mean, of course, a lot of folks, they think that all the trading action happens down at Wall Street, when actually it doesn't, in northern New Jersey, for all those. Well, I mean, they have some at Wall Street still too, obviously, but a lot of the guys, they have these huge warehouses with these big servers that reside in northern New Jersey, doing all that high frequency trading and such.
Right. So the nature of investing has changed due to the technological age. You also wanted to talk a little bit about the Fed. Is that also part of your economic theory? And did you have any charts or anything that you wanted to show besides the Twitter page that you're showing?
Oops. Oh, I didn't know it was live on the screen here. I'm sorry.
That's okay.
Actually, I could show one. One. This is just so I can just give you what I think is going to happen. As you probably well aware, as the Federal Reserve, they usually hike late in the business cycle, and what that happens is that basically they allow assets to rise or inflate to sizable amounts, and then of course, as they hike rates, and then you'll see a decline. So the one important thing is
what happened in 1937. The Fed made the same mistake.
Yeah, but actually, yes, but but the interesting thing is this isn't the first time the Fed's done this. Pretty much
Right.
with every major recession in the United States, the Federal Reserve has followed the same exact pattern. They set interest rates too low in the early portion of the business cycle, and then they allow the asset prices to, I guess you'd say, rise kind of out of control, and then they quickly raise rates, and then it induces a recession, or in some cases a depression. And this has gone on over and over and over. So it's the same playbook. The theory from the Fed is they're trying to adhere to the neutral rate, but the reality is the Fed is very slow when it comes to front-running risk. Because instead, they could have started raising rates even as early as mid-2012, like say third quarter 2012, even 10 basis points, which have been laughable at the time, but it would have stemmed some of the malinvestment and kept the markets going. I mean, they're still going now, but now obviously we're starting to see some rollover. That being said, the real yields is what's made a substantial move since December, moving from 50 basis points to 106 basis points. And this is important because this is seeing like flows into the dollar. And then now we're starting to see that funding rates like LIBOR has been rising quickly due to the supply of dollars drying up. And this has been in part impacted by the U.S. trade policy. And that really picked up in March, and it's going to continue. And the near term, we see the dollar reaching 98.5 by year end, and there's some pullbacks are possible because the Z scores right now are almost 2, and in that case, the support is likely to sit around 93.
Okay. Interesting. So I could show the dollar index. Okay.
Yeah, you don't mind.
All right.
Yeah, let's take a look at actually I wanted to kind of allude more to have people understand just how important the interest rate. Oh yeah, actually this would be great to show.
Okay. So there's the dollar.
Go.
So you're defining eventually you're looking for 98.
98.5 by year end.
Okay, and here's your support level right at the 200-day moving average, 93.
Yeah.
So I'm thinking we could do this first. Is that what you're thinking? All right.
Yeah, that's fine.
Okay. All right. So you want me to show interest rates too while you're talking about them? I can show the
sure.
bond
I mean,
market.
I just wanted everyone to if they haven't taken the time to look at the historical trends of interest rates and kind of now how the Fed has less, I guess you'd say, leverage or less tools to work with during the next downturn. Whenever that crops up. I mean,
so this is what you're talking about, the increase of rates. Here the 10-year yield was under 140. So we've more than doubled. So it's 250%. And people are saying, I want your reaction, Joseph, that, it's still a low rate, but isn't it more important? Isn't it more important that they more than doubled? Because a lot of people made assumptions based on rates, on the 10-year under 2 or at 2 and not 320.
Yeah, no, and I agree with you. And the thing is, you got to look at the markets. The rates are low historically, but the markets are elevated, right? So to them, when it's doubling, that's a sizable increase. So from the market's perspective, that's a big jump. I mean, if you look at this chart for past 50 years, you're going to quickly see that during the reign of Volcker, you'll see that obviously it's very low.
Right.
But so from today's, the markets are very sizable, and the rates of increases sizably for the 30-year.
Do you pay attention to the corporate debt market and with the tax cut that, a lot of corporations they've been able to borrow easily and cheap, and instead of investing in plant and equipment or new employees, they've been investing in financial engineering, paying out either share buybacks. So they're like leveraging their shares or in dividends. any opinion on the financial engineering, and could that be part of this unwind that you're talking about that's coming?
Yeah, and I think actually the commercial, the corporate buybacks is actually just another signal for the bigger issues at play, and a lot of them that a lot of people aren't paying attention to. I mean, there's starting to be some talk on Twitter about it, but it's the pensions, the underfunded pension plans, which is in today's dollars are sitting around $4 trillion in terms of being underfunded, and that only exasperate once the downturn occurs. So that's a big deal, because obviously a lot of folks who are on the verge of retiring think, okay, I'm good now. I put in my 20 or 30 years, and then they come to realize that they're not going to get the pension that they're expecting.
They're already cutting back. Even the Teamsters have cut back the amounts that they're sending out to people. Is that correct?
Yes, and actually with that too, that also puts another kind of another face to this, that historically not a lot, but a sizable portion of the population would view who work in government as them being safe completely, but that's not the case, because the reality is if the government only has so much money in their pension, then they're going to work with what they have.
Okay, so even government hiring or layoffs are in the future. So why don't you talk about what everyone's freaked out about, being replaced by a robot and technology. I really don't think the robot from Lost in Space could host a webinar as well as I do. But
no, your job's safe, so you're good.
I'm safe?
Yeah.
Huh?
Yeah.
Oh my God. It's the first time in my life I've heard I'm safe. All right.
No, well, but I mean, there's a human element to that, and that's to which, I mean, yeah, natural language processing as such is advanced, but it's not at human level.
Oh, yet. Okay.
But
I thought
no, no. But the thing is what markets are going to be seeing now is they're going to be the big focus is one metric, or maybe two metrics, is the profit per employee. I mean, yeah, that's always been a notable figure, but now it's going to be really focused on, because now they're going to try to generate as much profit per employee, and they'll be able to do that doing what's called robotic process automation. And a lot of firms have software that help companies kind of induce this, like that do that basically help implement this program. And it's, I mean, at face level, it looks like, oh, that's fine. It gets rid of the boring jobs. But the reality is, and I could tell you this, working as a data scientist, they can automate data science jobs. Now, generally, a lot of data scientists would argue that, but I think a lot of it's just from an emotional perspective. But most of the roles in data science today is just finding ways as quickly as possible to automatically import data, ingest data, and then spit it out through the machine learning models. So it's all kind of working in that kind of sphere. And now robotics has even kind of started targeting dentistry, surgery. Now in the States, you're not seeing that so much, but if you look in China, they actually have those robotics in operation.
Oh,
I mean, they're not wide scale.
There's robotic surgery here in the U.S. Da Vinci is the name of the machine, I believe.
Yes. Yeah,
Okay.
I mean, they have some here, but not. I mean, it's kind of in its infancy. I mean, yeah, the technology is made here usually or developed here, but like where it's more like wide scale. And I envision that's going to also be really popular too for a lot of governments that have state-run healthcare. I envision that, because that would be a cost saver for them.
Okay, everything's about saving money. So with all this displacement of people, do you believe that governments are going to have to go to universal income and just pay people to breathe in and out, because there's nowhere
Pretty much. I mean, that's going to be down the road. I mean, the good news is there's still time, I guess you can call it, time to change fields. And the reality is people are going to have to be willing to embrace the concept of continuous learning. Without continuous learning, that's where you're going to find yourself in a pickle. So the deal is you want to continuously learn new products, new technology, new processes, in order to circumvent technological unemployment for as long as you can. And also the thing is that a lot of folks aren't talking about, but it's not even automation of jobs is the scariest part, is semi-automation. Why? Because semi-automation is easier to implement than that of full automation. It depends on the program and such, but in general, semi-automation, because that's where you only need to hire a couple employees that can do the work for, 15, 20 employees, depending on your work environment.
Okay. Well, then if this is the case, this going on, do you think that there'll still be free markets, and will there still be trading, or will there be all kinds of capital controls and the markets may not be there? Do you think they're going to, we're still going to be able to trade going into
I hope so. I mean, the thing that I noticed was in 2008, because it used to be you only needed like, I don't know, a few $100s or something to open an account, but now they raised that limit to, what was it, 5,000? I forgot what it's called. There's some legislation a few years back. I don't know if they might raise those rates again, kind of like a higher barrier to entry. I envision something like that occurring, especially with this, whenever this next, downturn occurs.
Do you think we're on the verge of this dystopia that you're talking about? Do you think we're on the verge of how much time? You said you have time to make adjustments. How much time do you think people have to make an adjustment if they think they're in a vulnerable position, financially and employment-wise?
See, that's a challenge, because now a lot of the markets are really dictated by intervention, whether it's from a government entity or central banking entity. So it's really tough. I envision, there's already been hints, at least in the States, for Trump inducing another tax cut. I don't know if it'll actually go through or not, but there might be little small things like that to give people another last wave of, optimism before it goes down. But to me, it's already looking like a downturn could happen as early as 2019 Q2. Again, it kind of depends on the policies, right? Because the infrastructure bills hasn't even been introduced. Well, they've been introduced and some have passed, but the major ones, I think there's supposed to be, what is it, 1.1 trillion? Some absorbent, enormous number.
Can we get to our bailiwick? Do you take a look at currencies, and what do you foresee? Do you see the U.S. dollar losing its reserve currency status during this time?
Yeah, actually.
Go ahead.
I'm actually in the process of finishing up a Fed book. The tentative name is Fed Follies. And I actually write a whole chapter or two on a new international reserve currency.
Oh, an SDR?
Yeah.
SDR by the IMF, that's based upon the size of the currency is based upon the country's GDP versus against debt or something?
I don't envision it being an SDR, because you have a thing called the Triffin's dilemma, and where basically those are holders of the federal international reserve currency. They basically have to be in perpetual debt because they have to ensure they meet the liquidity needs of the global market. And so what I envision it looking like is kind of, I guess you'd say, it's a little different than a lot of people's opinions, but I envision it being politically autonomous and electronic.
Like a digital Bitcoin?
Yeah, something like that, except it won't be Bitcoin. But it'll be an electronic, and I envision it being administered by a financial consortium, like say the IMF, and I envision it to be following the electronic scale, and it'll be scalable, and it'll follow along the lines of, I envision it being an energy efficient blockchain, or like an energy efficient cryptocurrency, if you will.
Okay.
And the reason why is because
because of all the energy use that's needed to
yeah,
mine Bitcoin.
yes, or
Okay.
cryptocurrencies in general.
Yeah.
Yes.
Okay.
So something that's going to be efficient and it'll be administered by, say, an IMF, or probably be overlooked by the Bank of International Settlements. And then the way I
and cash
envision
is gone. Cash is gone.
yes, cash is gone. I mean, that's already been a choice of people for a decade now or longer, you know?
Will the archaic relic gold and protect people during these times?
I think gold's an excellent vehicle for initial like crisis mode, but then once they actually introduce these different programs, and then then it won't be as helpful. But I think during the initial crisis mode, absolutely.
Okay, yes. Silver too?
Yes, absolutely silver. Yeah, and silver's been undervalued for a long time.
Does technology eventually cause such an oil glut that oil's back under $20 a barrel and we're moving towards EVs and fossil fuel really becomes a fossil?
That's a good question. I think the challenge that I don't have any direct research on is looking at how the oil companies, their financial load is. Like, how is it going to look during a financial crisis? Will they still be able to maintain their operations effectively? So I haven't looked at their debt load to basically be able to know that, at least in the immediate future.
Okay, well, Joseph, I noticed on your Twitter here, here you are, that you don't even have a link. So this is the only way really for people to get a hold of you is that
they can get
economic hedge.
Yes, Twitter right now. The site that I also have is called doorway.ai, but it's not open. It's not ready yet. It should be ready by weekend, at least the preliminary setting of it.
Okay, and that's going to be some type of subscription model for you?
No. It's going to be more of a consultative approach. Like, basically, I'd help organizations deal with the upcoming changes in the economy and the changes of technology and how it impacts their businesses. Mm-hmm. And I'm also going to have another segment which will help individuals who are looking to circumvent technological unemployment as long as possible. I'll be providing tools for them to do that. Like I've right now creating some modeling of the probability of your job being automated is this percent and such.
Okay.
Yes.
Okay. So well, Joseph.
Yeah.
I want to thank you for joining us today. It was fascinating.
Yeah. Thank you for having me on.
And uplifting for me that I'll still be able to jabber and no one could replace a robot can't do what we do here at ForexAnalytix. That you still need the human element to communicate content to an audience.
Yes.
You're sure we're safe now?
Well, I guess it depends. See, that's going to come back to people's preference. I mean, if people really like robots, and that's say.
Yeah. Okay. So now I don't feel as safe as I did before, but I do feel enlightened by some of the things you talked about, and you have a great mission because if there's ever going to be an adjustment. This is more than just a reversion to the mean in asset prices. This is a whole new world that we're looking at. So appreciate you coming on today, Joseph, and I wish you success in helping others make it through this.
Thank you.
All right, Joseph.
All right.
All right, thanks again. All right, everybody. That's a wrap. Good hunting. See you in the chat room. If you need a new broker, contact Trent at Forest Park FX, and don't forget to join ForexAnalytix. They are the dream team. Adios, everyone. And most of all, don't just count your pips. I'm talking to you, Steve Volge. Count your blessings. And I'll see everyone tomorrow. Enjoy the rest of your day. Adios.